market doesn't just react to results, it reacts to expectations. So the big question was, would Disney live up to expectations? This is important. Disney Plus lost 700,000 subscribers last quarter. Anyone paying attention could have seen this weeks ago. And this brings us to the main concern, how much this new next-door neighbor will impact Disney. Disney just released its latest earnings report, and the results? Well, they might surprise you. But here's the thing, earnings aren't just about whether a company did good or bad. It's all about expectations. Today, we're breaking it all down in a way that actually makes sense, without confusing Wall Street jargon. Let's dive in. For amateur traders, earnings reports can feel like a puzzle. A company might post strong revenue and profits, yet the stock drops. Other times, the numbers seem underwhelming, but the stock rallies. Why does this happen? Because the market doesn't just react to results, it reacts to expectations. Today, we're unpacking Disney's latest earnings, what investors were hoping for, what actually happened, and why the stock moved the way she did. Before Disney released its earnings, Wall Street had high hopes. The company was coming off a strong quarter, and thanks to major box office hits like Moana 2 and Mufasa, The Lion King, analysts were expecting another strong report. Projections called for Disney to earn $1.45 per share and bring in around $24.67 billion in revenue. Investors were also watching Disney Plus closely, as the company had been working toward streaming profitability. At the same time, there were concerns. Theme parks had been struggling due to economic slowdowns and hurricane-related disruptions, which impacted attendance and operations. Additionally, Disney had warned that subscriber growth for Disney Plus might slow due to recent price increases, which could lead to higher churn rates. So the big question was, would Disney live up to expectations? Well, here's what actually happened when Disney released its earnings on February 5th, 2025. Revenue. Disney brought in $24.7 billion, which was in line with expectations, marking a 5% increase from a year ago. Earnings. Per share. It was a mixed bag, which explains some of the zigzagging initial market reaction. Disney reported diluted EPS of $1.40, which was 5 cents lower than FactSet's analyst estimates. However, adjusted EPS came in at $1.76, beating a different set of analyst estimates compiled by Bloomberg. So, a miss on one side, but a beat on the other. Disney Plus subscribers. This is important. Disney Plus lost 700,000 subscribers last quarter. At first glance, this sounds bearish, especially compared to Netflix, which added 18.9 million new subscribers in the same period. However, the stock didn't tank because analysts were already expecting weak subscriber numbers. Beyond seasonal trends, they knew Disney had recently increased prices by 15% to 25%, so cancellations were inevitable. In fact, Disney had anticipated even higher subscriber losses, but was pleased that retention held up better than projected. See why it's important to dig deeper. With this perspective, some analysts even viewed the numbers as slightly bullish. Not because Disney Plus grew during the quarter, but because the decline was less severe than expected, and profit margins improved. The company itself echoed this sentiment. Hulu and ESPN Plus saw gains, helping keep the overall streaming segment stable. Theme parks. Revenue from Disney's Experiences division remained flat, impacted by hurricanes and pre-opening expenses for the Disney Treasure cruise ship. Movies and streaming. Moana 2 helped push Disney's content sales and licensing to over $300 million in operating income, a major turnaround from last year's losses. And let me share another interesting insight. Moana recently crossed $1 billion globally, just from the box office. But here's the thing. You don't need to be a Wall Street insider to realize Moana 2 has been a commercial success. Anyone paying attention could have seen this weeks ago. The smart money moved in anticipation of these results, not because of them. When a movie outperforms, smart money doesn't wait around for confirmation. It moves in anticipation. Keep that in mind. As for CEO Bob Iger, his leadership has been pivotal in Disney's turnaround, which the board acknowledged with a 30% pay increase, bringing his total compensation to $41.1 million for 2024. Overall, this was a mixed report, but mostly because two key narratives had already been priced in. That's why the Disney Plus subscriber loss wasn't catastrophic, while Moana 2's success wasn't a major surprise either. At the end of the day, earnings aren't just about the numbers. They're about expectations. Some analysts saw the results as a beat, while others saw a miss. That's because different analysts use different expectations, which leads to confusion among investors. This explains why Disney stock initially popped, then pulled back. It wasn't a clear win or loss. Now, one thing worth noting, the market would have liked to see Disney raise guidance, but that didn't happen. And this is important to keep in mind because while Disney's EPS grew 40% this quarter, they're still only forecasting full-year EPS growth in the high single digits. Some analysts believe this could be Disney's way of managing expectations and protecting itself against rising competition. And this brings us to the main concern, Universal Epic Universe. NBC Universal's brand new theme park is set to open this May in Orlando, featuring 5 themed areas: Celestial Park, Dark Universe, Isle of Berk from the How to Train Your Dragon franchise, Super Nintendo World, and the Ministry of Magic from the Wizarding World of Harry Potter. There's still a big question mark around how much this new next-door neighbor will impact Disney. Will it draw visitors away and deliver a serious blow to Disney's parks? Or could it lift the tide for all theme parks, attracting more visitors to both Universal and Disney? The jury is still out. Now, what does all this mean for your portfolio? If you're a day trader, a mixed bag earnings report like this creates wild volatility, perfect for intraday plays, especially with a stock that typically trades around 7 million shares per day. For swing traders, it might be wise to wait until volatility settles and real volume confirms a direction. For a medium-term play, the key catalyst to watch will be Disney Plus subscriber numbers next earnings and the impact of Universal Epic Universe once it opens. For position traders, aside from those two catalysts, there's another major shift to monitor: Disney's plan to move ESPN away from traditional cable subscriptions. That transition is expected to roll out in the fall and could be a game changer for Disney's sports division. And if you're thinking beyond this year, then there's another big move Disney is making, expanding through cruises instead of just parks. But these aren't just regular cruise ships. They're floating theme parks. But that deserves its own deep dive. Stay tuned. If you enjoyed this breakdown of Disney's earnings, if you're curious about Disney's latest project, or if you want more market insights and stock catalysts, consider subscribing to Boursa. As always, stay curious, imaginative, and unaffected.